Okay, let's dive right into this. Welcome to today's Explainer, where we are going to completely demystify the black box of how lenders truly evaluate your stock when you're looking for capital. Most shareholders walk into a stock loan conversation making one massive assumption. If my stock is listed and it's valuable, the loan is practically guaranteed. But as we're going to see, that assumption couldn't be further from the truth. Today, we're unlocking the lender's assessment process to show you exactly what happens behind closed doors before an approval is ever issued.
Here is our roadmap for the explainer. We'll quickly hit the core misconception, the 4 assessment pillars, translating terms, why application stalls, and finally, how to prepare your application. The goal here is simple. We want to unlearn those old borrowing habits and entirely adopt the mindset of an underwriter.
All right, Section 1, the core misconception. Unlearning traditional finance.
So, transitioning from traditional loans to stock loans is a massive paradigm shift. With traditional underwriting, lenders are laser-focused on you, your earnings, your cash flow, your personal capacity to repay. But stock loan underwriting, it flips the script completely. It is entirely asset-led. Your personal wealth, your flawless credit score, in this context, they essentially don't matter. The lender is underwriting the security, not the shareholder. The absolute only thing that truly matters is the tradability of the stock itself. This quote right here really hits the nail on the head. The starting question is not whether the borrower can service debt, but whether the lender can manage and exit the position if required. You have to start thinking of the lender through this exit-minded persona. They aren't loan officers trying to figure out if you're a reliable person. They're risk managers. They're focused entirely on how easily they can sell the collateral in the open market if things go south. If they can't manage and exit the position safely, there's no loan, period.
Moving right along to Section 2, the 4 assessment pillars, filtering the collateral.
Now that we've shifted our mindset, how do these risk managers actually filter your collateral? Keep in mind, passing basic KYC or AML compliance gates, that's just table stakes. Only the stock itself generates the approval, and underwriters evaluate it through 4 distinct pillars. Pillar 1 is liquidity, measured by average daily volume, or ADV. Think of it like this. Imagine you need to sell a massive block of shares quickly. If you drop that block into a tiny, shallow pool of market trading, you're going to create a tidal wave that crashes the stock price, right? But drop that same block into a vast ocean of daily trading volume, and it barely makes a ripple. Lenders need the ocean. They need to know the stock trades with enough volume to absorb a worst-case sell-off safely.
To put some hard numbers on that concept, a position representing 2 or 3 days of average daily volume is generally totally manageable for a lender. But a position taking up 20 days of ADV? Oh, that is a massive liquidity and price problem. And hey, the listing venue matters tremendously too. If your stock is on major exchanges like the LSE main market, Euronext, HKX, underwriters see the regulatory oversight and settlement certainty they need. But if it's sitting on AIM or OTC markets, you're going to attract much more conservative rates if you qualify at all.
Which brings us to our second pillar, concentration. A stock can have incredible daily volume, but if your stake is a massive, say 15 or 20% chunk of the public free float, that creates a serious problem. Lenders look at that and realize their ability to manage the collateral without moving the market is heavily constrained. For concentrated shareholders, lenders will almost always cap your eligibility or drop your advance rate to protect themselves, regardless of how good the headline trading volume looks.
Pillar 3 is volatility and risk profile. Once they know the stock is manageable, they look at volatility to figure out how much they can safely lend. That 50 to 60% loan-to-value range you see, that's the standard benchmark for a low-volatility, large-cap stock in a stable market. If your stock is swinging wildly or if the broader market is just stressed out, you can absolutely expect that advance rate to get dialed down.
And finally, we reach the 4th pillar. And guys, this is an absolute deal breaker. Regulatory and transfer restrictions. You could literally be holding $50 million in a highly liquid, incredibly stable blue chip stock, but if there is a tiny piece of legal paperwork attached to it, like a lockup period, a restricted legend, or an insider affiliation, the deal's dead in the water. In this market, shares must be 100% free trading to function as collateral. Let's look at Section 3, translating assessment into terms. Once your stock has successfully navigated those 4 pillars, we move to the next phase. Now, a big misconception here is that an approval is just a simple yes or no. It's actually not. The output is a proposed term sheet that presents a range of variables based entirely on the risk assessment we just talked about. We're looking at a spectrum: loan to value, pricing, term length, and margin trigger levels. This entire range directly reflects how the lender views your collateral. They're asking, how will this specific stock behave under extreme stress? The riskier the stock, the tighter and more conservative these terms are going to be.
Now, Section 4. Why applications stall. A practical example.
Let's see how this actually plays out in the real world. Imagine a borrower with a great liquid FTSE 250 stock and clear title, but they submit an application with an active lockup period expiring in 2 months. Look at the reactions. Lender A and Lender B decline the application outright. Why? Because their internal policies forbid restricted securities under any circumstances. But Lender C takes a totally different view. They assess the stock, like what they see, and offer a 45% LTV on a 6-month term, perfectly conditional on that lockup expiring. It's the exact same high-quality stock, but 3 completely different reactions solely because of a temporary legal restriction.
Following this timeline, it makes total sense. The application goes in with the lockup. The lenders react. Then, the 2 months pass, the restriction legally lifts, the title is clean, and boom, drawdown proceeds with Lender C. The ultimate success here depended entirely on having the right counterparty. If this borrower had only spoken to lenders A and B, they would have walked away thinking their stock was unmarginable, when really, they just needed a lender who allowed conditional advances.
Which brings us to Section 5, preparing your application, the playbook. Since we know how underwriters think, you can take complete control of the process before you ever speak to a lender. Let's rapid fire through this checklist. Step 1. Confirm your shares are 100% free trading. Presenting restricted stock as freely tradable is literally the most avoidable mistake in the industry. Step 2. Calculate your context. Know your percentage of the free float and ADV. Step 3. Set realistic expectations. 50 to 60% LTV is standard, asking for 80% just wastes time. And Step 4. Anticipate variations. Different lenders have different rules, so expect mixed responses. And this brilliantly illustrates our next point, perfectly captured here. The absence of a single approval is not the end of the process. It is information about which part of the market that particular position fits. Getting a rejection isn't a failure. It just means you haven't found the right match for your stock-specific risk profile. This is exactly why working with specialist intermediaries who understand these varying lender appetites is absolutely critical to getting your deal placed. I want to leave you with this final, provocative thought. You might look at your portfolio and see millions in highly valuable equity, but you need to strip away the market price and ask yourself the only question that matters to an underwriter. Is it actually manageable? Can a lender comfortably exit your position in a crisis without crashing the market or getting tangled up in legal red tape? I challenge you to look at your own portfolio through that exit-minded lens. Once you do, you'll be ready to navigate the market with total clarity. Thanks for joining me on this explainer, and be sure to check out the Securities-Based Lending Playbook to take your understanding even further.